Hey, what's up, guys? Just got home from the arcade. Won my kids 3,700 tickets. Let's go! Dad for the win. But I wanted to make you guys a video about Nav erosion and how covered calls sometimes lead to Nav erosion. And I want to show you how that works. Now, the interesting thing here is you could be buying a covered call ETF, or you could be doing covered calls yourself and still lead to Nav erosion. That's like the amazing part of it. So I always say this, always use the S&P as your benchmark. You not only need to, would you be better off just buying the index? Is the question you should always be asking yourself. If you're not beating the index, which, returns 10%, if you're not beating that by a substantial margin being your relative alpha, then maybe you shouldn't be doing this, or maybe you should just buy the index. It's always something to keep. That should be your benchmark. It shouldn't be zero. It should always be, should I at least, like, can I beat the index? All right, so we're gonna get rid of this. This is all about how, this is one of my last videos, and using margin to live out of. All right, so we're gonna do this with Google because this happened to me. Now, arguably, I'm still gonna be like just in profit, like by an insane amount. But would I have been better off just holding? Okay, we'll use, so my particular ticker that because there's a bunch of different Google stocks, I'm using Goog. So I believe my cost basis was like, it's like 150, okay? And it was right around, I think it was like 300. And then I did a covered call on it. So I totally screwed that up. My cost basis is 141. Okay. Again, it's on Goog. Current price is 260. I had sold a covered call for 205. I thought, for some reason, I thought that we were only going to go up maybe, I don't know, a couple percentage points, maybe 5 or 6 percentage points on this earlier in the year. And I was just going to, get the covered call, which my covered call paid $1,269. Great, whatever. And that's fine. I had no intention of it keep running. So this is how the Nav erosion works, right? So when this gets, now I still have a couple months before expiration. So my expiration date is 11/21/25. It's coming up here in the near future. And unless we have a massive pullback, which I don't think will happen, this is going to get called away. It's going to get called away for 205. Now, arguably, I made the spread there. It's not, look, obviously the spread between 141 and 260 is, $1.19, but it's not like I'm losing money. However, this is where we would start to lose money, whether or not like I was going to continue to play this like a hamster wheel, or if I was an ETF that strictly does this and like they're forced to, right? Because they have to pay out a dividend. This is where the Nav erosion can potentially kick in. Okay, so say I am, I don't know, I'm gonna be Zeus Fund, just because I don't think that's an actual fund, and I'm not trying to hurt anyone, or anyone's fund. So I'm just making this up. It's completely fictional. All right, and so I'm a fund manager, and I have to do this. I have to produce a massive income because I promised everyone dividends, weekly dividends. So the fund runs up to 260. I'm forced to sell it here at 205. Okay. I collected this. I distribute this out to investors, my shareholders, right? But now what happens? I'm making profit. However, now I have to buy in at a higher cost, right? Because I made a promise that I was going to make dividends. Now I'm getting between 141 and 205, 6,400 bucks. That's great. However, because I'm forced to buy in, I have a couple options. I could say I would rather this. And just so you guys know, in order for me to close this, I have to basically pay that. Like my cost to close early, if I wanted to keep my shares, is like almost a 1-to-1 ratio of what your difference is. Just so you know, that's how that works. So I could either take that, either not distribute out to investors, or maybe a lesser amount. Okay, so sometimes you'll see the interest drop. That sometimes happens. Or say I have, I don't know, 1 billion. I'm trading $1 billion on a management. I have to buy in at a higher notional value now. Remember, I'm getting this, which is 20,500, but now I have to buy in for 26,000. Okay, that's a loss of NAV because I can only buy. I'm not getting as many contracts. I'm leaving skin on the table. Okay, this can happen in your personal account, and as so if it's coming out of your NAV, your dividend ETFs might be going like this. The other way to do this is say I roll this. I pay this money back. I still get to distribute this money out. Okay, but my cost to close is this, and then I'm going to collect another set of premiums. But I'm gonna extend I'm gonna push my new date. I'm gonna do a new sell to open, maybe for, I don't know, 265. Okay, collect premiums. Which I don't know, maybe it's I don't know, 1,500 bucks. Technically I'm still down because I just gave up 6,400. Well, I got the net difference, right, which is, I don't know, like 4,800 bucks, something like that. Okay, and then I collected 15, but I'm still negative. I'm still negative, like, I don't know, like 3,200 bucks. I'm just doing the quick math in my head. It's probably not accurate, but that's still going to be reflective of the NAV going down. So that's kind of the issue with covered calls, is you have a couple different ways to get out of it. If, in order to not be negative, right, because you're looking for a net credit, you basically have to sell super far dated, okay, expiration date to get a net credit. I actually have some in my portfolio right now that I'm doing in order to get this net credit, because I refuse to take a loss. I'm a really poor loser. So I'm still technically unprofitable, but my expiration's wicked far out. Now, the only thing I can hope for is basically a dip, a crash. Not a crash, but a healthy pullback. And if that happens, then I can buy to close early. Keep the shares, and maybe it has a healthy pullback back to, this area. That's essentially what I'm looking for if I'm going super far out. But in the meantime, if you're constantly recycling the same money over and over again, and it's very important, this is how I teach. you want to be opening. So if the price is going like this, right, and you have you'll have like some of these crazy, movements, throughout the year. You're looking for that trend line, the upper and lower. These are your cash secured puts, CSPs, okay? You're gonna sell them down here and you're gonna covered call them up here. If it goes way outside of your standard deviations, you're gonna have to wait until it falls back in a range, and it will find a range. Everything finds a range eventually. But for anyone that's in a covered call ETF, this is a strong possibility of what can happen. Unfortunately, sometimes it's good to, if you see, fund managers can't always do this, especially if they have if they have a single ticker ETF that trades, a covered call, say on Apple or Google, because we're doing Google. They have to, they've made a promise that they're going to pay you some form of dividend. They pretty much basically have to take a trade, even if they know it's a crappy trade and it could potentially work against them. Basically, their hands are tied. As an individual investor, though, you have the opportunity to just say, you know what, it's out of my range right now. It's either overbought or oversold. I'm going to sit this one out. I'm going to wait for the setup. And that's the hardest part, because look, everyone's a genius, including myself, when we're winning. And we've had nothing but home runs and bull markets. I mean, my individual portfolio was up 70% for the year, crushing it. Everyone in my Discord group is crushing it. However, sometimes things are they're just too high. They're just too high, and like the setup's just not there, and it's super hard to like put your ego aside and just go, it's not worth the risk. I'm gonna wait for the pullback. And because what happens is, if you take a covered call, this could result in a small loss. If you take a covered call and say the market dips pretty hard, you can sell to close early. You can buy to close early. Your shorts, if you're a short seller, or the other, and then obviously you would sell out your position. But that's like, it's a lot of like a mental stuff up here. It's all mental. It's you versus you. In this whole trading thing, it's like you versus the computer. Sure, there's another player on the other side of the computer, but a lot of those little decisions, it's all going to be up here. It's all mental. I gotta be sure not to like marker myself. That'd be kind of funny. But that's it. That's one of the issues with the covered call, is that you could be, even if you're profitable, like with my Google trade, I guess that's it. I gotta wait for the next giant pullback and re-enter. Even if I re-enter, I have to assume that it's gonna fall back. Or if I still want, and I can make a video on this if you guys want, if I still want access to it, no, it's still gonna result in if I'm looking at it, because I'm gonna get called away at 205. It is what it is. If I still wanted, it depends on where the delta is. You could do a one call delta, which is a synthetic, and that would track the current price, but still it's probably gonna cost you $2,600. Again, you have, that is, what your downside risk is, and you have unlimited upside, and you could sell covered calls against it, but you wouldn't be able to necessarily margin against your shares. So like, it all depends on how you guys want to take this, or you just wait for the next big pullback and you keep some fresh capital, which interest rates are falling. I just don't see it happening anytime soon. So anyways, those are two aspects of how NAV erosion can work. There's a ton of different ways, but that's just like a good, I think I'm just going to stop it there. It's just a good model. And I think it's probably the most common. Share price keeps ripping, which begs to question, quite honestly, in the bull market, and you'll know who's doing this. Okay, this is what I want you guys to look at. I want you to look at any of the dividend ETFs you're following, all right, or that you have in your portfolio, and I want you to match them against the underlier. If the underlier is like straight fucking up, right, and its lower counterparty, the high dividend ETF, if it's kind of either trending sideways or falling down, like it's falling away, it's separating in price, that's because the dividend ETF they're selling covered calls to in the money, and they're continually getting called away. So unless everyone is just jumping in with more and more money week after week, pushing the NAV up, because it's assets under value, it's assets under management. If they're pushing the NAV up by everyone's jumping in, adding more money, that fund is going to start separating from the underlier. It'll start trending down while the underlier goes up like this. And that's because they're getting called away, and the ETF is getting called away and having to buy in at a higher strike price. Up, 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 up. And in a bull market, unfortunately, you end up trending down. And God help you if this is the other problem, is as you're trending down, okay, you have a 1-to-1 ratio of the underlier. Okay, I don't know if that makes sense. It's a covered call. That means like you either have a synthetic or you actually own the shares. So you still have a 1-to-1 loss ratio. So if the underlier goes up, say 10%, and then falls 20%, your covered call ETF is also going to fall 20%, but it might not recoup that the underliers perform. The underlier shoots back up 30%. The ETF is going to try catching up, but it keeps getting called away. So it's having to buy at a higher strike price. So eventually the covered call ETF will end up trending downwards because it's going to capture all of that. It's 100% subject to the downside, unless it's like Curve has protective puts. So it's like kind of like a stop loss. But, and it has limited upside. That's one of the problems. So over time, the next 10 years, you're going to see a lot of covered call funds, unless they trade 0 DTE, days to expiration. You're going to start seeing a big divergence between the underliers are just going to be taking off, while, the covered call funds are just slowly eroding, even with dividends reinvested. It'll just be it'll be a slow drip. Even if you get your 100% money back, you will still have a little bit of NAV erosion, unless the fund manager adds some sort of protective put, or they start trading up the strategy a little bit, which is very possible. That has happened before in the past. I'm not saying it will happen or it won't happen. I'm just saying it's a possibility. And that's NAV erosion.